Happy New Year, financial freedom fighters. The new year has just begun. It's almost time to get that big fat bonus check from your boss. Do you know what you're going to do with it? Spend it on a shiny car? Take a fancy vacation? Want to hear my recommendation? Invest it for your financial future. Of course, spend some of it on things that bring you joy, but then try to invest a major chunk of it. A question that gets asked very frequently is, should I invest all of my bonus money in a lump sum in this market environment? Or should I invest it bit by bit using a strategy called dollar cost averaging? And that's the topic for today's video. I will show you how these two strategies would have worked using Tesla and Constellation Energy. Hi there, I'm Avanti. I'm a mom, an investment analyst, and a CFA charter holder. Subscribe to my YouTube channel and follow my Facebook page to learn how to build wealth through investing. Let's say I received a $156,000 bonus. It's the least common multiple of 12 and 52 multiplied by $1,000. It'll become clear why I used such a random number. I now have the option to invest the entire amount immediately, or I can use dollar cost averaging. Dollar cost averaging is a strategy in which you would divide the total amount into smaller, equal-sized chunks and invest those smaller chunks at regular intervals, regardless of what the market is doing. So because I chose this magic number 156,000, I could choose to break it into 12 equal chunks, each with $13,000, and invest $13,000 each month for 12 months. Or I could break it into 26 chunks and invest $6,000 every 2 weeks. Or I could break it into 52 chunks and invest $3,000 each week. In all of these scenarios, over the next year, I would exhaust investing all of the $156,000 just in time to receive my next annual bonus. Do you understand now why I chose 156? You can invest in any kind of asset using this strategy, and I will discuss some of your available options in just a few minutes. Let's say I chose one asset to invest in, and let's say a single unit of this asset today is priced at $100. I choose to dollar cost average every month by investing $13,000 every month in this asset. Because one unit costs $100, I can buy 130 units of this asset. Next month, let's assume that the asset's price went up to $130. I will then be able to buy 100 units of this asset. The month after that, the price, let's say, falls to $65. Then I will be able to buy 200 units of this asset, and so on. I have this table that shows the per unit price of the asset each month in the first column. The second column shows the number of units I can buy for $13,000. And the third column is just the first two columns multiplied together. And as expected, the product is $13,000, which I plan to invest each month. Notice anything? When the price is high, I get to buy fewer units of this asset. And when the price is low, I get to buy more. The average price I pay is the total dollar amount of $156,000 divided by the total units of this asset which I bought, which is this price. This price is lower than the simple average price of the asset over the period. You see how this value is just a simple average of all these prices versus this lower price is the average of these prices weighted by the number of units I buy. And because I buy fewer units when the price is high and more units when the price is low, it helps bring the weighted average price down. I hope this is intuitive. If not, take a pause and go over these values. If you didn't understand a concept, ask questions. I read every single comment. Who should use dollar cost averaging? If you are risk averse, or if you're just starting to invest and don't have a lot of experience investing, Dollar cost averaging may help mitigate some of the risks associated with investing. So if you're waiting for the right time to invest, dollar cost averaging is for you. And you could start investing today. Dollar cost averaging can also help seasoned investors in volatile markets. In times such as these, when you have no idea what's going to happen with your assets, you can slowly ease into the asset by investing a little bit at a time. And you can choose your own time period. Just because I said 1 year, it doesn't have to be that. You can choose to dollar cost average over 4 months or 6 months or whatever you are comfortable with. Investing is a long-term game. I personally don't day trade and I don't encourage it either. As with any investment, take into consideration your investment goals and constraints. To understand what they are, watch this video where I discuss how to create an investment plan. So here are some pros of dollar cost averaging. Dollar cost averaging helps create a discipline around investing and takes the emotion out of the process because you are investing regardless of what the market is doing. This strategy is fairly easy to implement. You may already be using the strategy whether you know it or not if you have a 401k. What happens in a 401k? Your contributions get invested at regular intervals in assets of your choosing, right? You don't think twice about doing it in your 401k account. Dollar cost averaging helps reduce the risk of loss from the volatility of asset prices because you get a weighted average price that is lower than the average asset price over the period. Finally, it's a great strategy for long-term investors who may be risk averse. Before I talk about the cons of dollar cost averaging, please show me some love by hitting that like button and share this video with one person who may get some value out of it. And if you're new here, please subscribe and hit the notification bell so you don't miss any new video. If you're watching me on Facebook, don't forget to follow my page and please comment below what you like and what you want to hear more about in my future videos. If you have questions, feel free to ask. And if you want to learn how to invest in the stock market, don't forget to watch this free course on the basics of stock market investing for beginners. I was super nervous when I first made my Apple stock purchase, and I can understand how overwhelming the stock market can be. My course is designed to take the overwhelm out of investing. With that out of the way, let's get to the cons of dollar cost averaging. In my earlier example, I used a hypothetical asset. Let me show you what would have happened if that asset was Tesla common stock. I'm assuming I started dollar cost averaging on 31st January of last year, investing 13K every month at the end of the month. The first column shows the purchase date, second column shows the purchase price, third column shows the number of shares purchased, and the fourth column shows the dollar amount that I spent each month, which is $13,000. On December 30th of 2022, I would have purchased a total of 646 shares of Tesla, which is the sum of all the shares in this column. December 30th price was 123.18, which means at that date, all my shares of Tesla would be worth roughly about $79,591, product of price and shares. The total purchase price is $156,000. That makes my paper loss equal to the current value minus the purchase price, which is a loss of $76,409. Now, instead, if I had invested everything in a lump sum on January 31st of 2022, I would have bought about 500 shares of Tesla instead of 646. On December 30th, they would have been valued at $61,543. That would have made my paper loss equal to $94,457. So in this case, dollar cost averaging helped reduce my potential loss. Now let's look at constellation energy. Same exercise, same exact columns, but in this case, price has risen over the year, unlike Tesla where it declined. You can pause the video to see what's going on in the table. At year end, I would have bought a total of 2,376 shares if I had dollar cost averaged over the year. That makes my total share value equal to the number of shares times the price of 86.21 equal to $204,878. That minus my total investment of $156,000 makes my paper profit equal to $48,878. Now, instead, had I invested my $156,000 in a lump sum on January 31st itself, I would have had 3,250 shares, making the year-end value of shares equal to 280,183, and my paper profit equal to 124,183. In this case, I would have missed making a higher profit by dollar cost averaging. So when the market is rising, dollar cost averaging may result in a lower return compared to lump sum investing. But there is no way to know beforehand what's going to happen. So it really depends on your risk return profile and specific investment goals. There is an opportunity cost to dollar cost averaging. Also, I didn't consider time value of money in this discussion. Dollar cost averaging does not guarantee a profit. Another potential disadvantage is fees and commissions. Depending on what asset you choose to invest in, frequent small trades may incur higher costs than a single investment in lump sum. Just as I ran a couple of hypothetical scenarios, you could too, and see how returns can fluctuate. But it's important to know that historical performance is not indicative of future returns. I have used dollar cost averaging several times in the past, and here's a list of investment vehicles you can consider. Mutual funds. Mutual funds offer a systematic investment plan that you can employ to automate your dollar cost averaging. Vanguard, Fidelity are great options to consider, but choose funds wisely. In this video, I talked about how seemingly low mutual fund fees can erode your potential return. If you're looking to invest in indexed funds, watch this video where I discussed my favorite index funds. Next option is ETFs. Similar to indexed funds, you can choose low-cost ETF counterparts through Vanguard. Investing in ETFs may not be as automated as is investing in mutual funds, but if you can set periodic reminders for yourself to invest, this can be done with ease. Another option is individual stocks, and I don't encourage dollar cost averaging big amounts in any individual stock because of risk of concentration. A well-diversified portfolio has generated better returns historically. Index funds and ETFs are my favorite assets to dollar cost average. Go watch this video next, and if you found any of this information to be of any value, please like this video and share it around. I want more and more people to start investing for their family's future. And as always, don't forget to be happy, to be kind, and to be your best self. Bye. And again, Happy New Year.